If you're a first-time homebuyer wondering which mortgage program is best for you, well, I'm going to show you exactly what I feel the best programs are in this video and how you can save money with each. By the end of this video, you're going to know the best first-time homebuyer programs for you and how to pick the right option. I'm Brand the Mortgage Man, and I have helped more than 10,000 homebuyers over my 20-plus year career in mortgages, and today I'm here to help you. So let's get into the best mortgage programs for first-time homebuyers like yourself. So the first program that I feel is best for first-time homebuyers is going to be an FHA mortgage. Now, something you want to keep in mind is that FHA mortgages, although they're most commonly used by first-time homebuyers, they're not just for first-time homebuyers. But let me point out a couple of really key pointers about FHA that I like. For one, they're very flexible when it comes to credit score. So you can actually have a credit score as low as 580 with most lenders. As a matter of fact, some lenders will even go down to a 500 credit score. However, that's going to require a larger down payment. But let's just say rule of thumb across the board, most banks and lenders will allow you to go as low as a 580 credit score with an FHA mortgage. Second, the down payment, 3.5%. You only need to come up with 3.5% of the purchase price to cover the down payment using an FHA mortgage. Now, here's a pretty cool one. If the property is owned by HUD, HUD is the entity that actually insures FHA mortgages. If they happen to foreclose on a property that had an FHA mortgage on it, there's something called the HUD Home Store. And the HUD Home Store lists all those properties. If you're to use an FHA mortgage to purchase a home that's listed on the HUD Home Store website, you can actually use a mortgage FHA with just $100 down. Legitimately, a $100 down payment using an FHA REO mortgage, real estate owned by HUD, which is pretty cool. You can't do that with any other mortgages. Those are two huge ones. Now another one, debt to income ratio, DTI, right? If you watch any of my other videos, and if you haven't, make sure to subscribe to my channel so you can keep educating yourself on mortgages. But I do videos on what a debt to income ratio is, what lenders are looking at, and how they calculate it. But real quick, your debt to income ratio is how much money you make each month versus how much money you spend each month, including the property you're buying. Now, with an FHA mortgage, there are two parts to it. Part one is your housing ratio. Housing is what your payment will be on the new property you're buying in comparison to your income. That goes all the way up to 47% of your gross income, meaning your income before taxes are deducted. The second part is your total debt ratio. Total debt ratio is your housing plus any other expenses you have that report to credit. Car payments, leases, student loans, any type of loan for that matter, credit cards, right? Those are all your existing debts together. So that actually can go up to 57%, once again, of your gross income, meaning your income before taxes are deducted. That is very high, right? So in my opinion, these are some of the key factors and the things that make FHA mortgages great for first-time homebuyers, because a lot of you, right, fall into this category. That's FHA. So what we're going to do now is we're going to look at another type of mortgage that I also feel is a great option for first-time homebuyers, and later on we'll get into exactly what payments look like, down payments, and so forth when utilizing these programs. So the second is a conventional mortgage, and this is probably what you are most familiar with, what most home buyers are familiar with, a conventional mortgage. But what you may not know are these things. For one, conventional mortgage. Your minimum credit score for a conventional mortgage needs to be 620, 40 points higher than an FHA. Now, that's not a bad thing. I think 620, a lot of you probably have that or probably have a higher credit score than that, but that's your minimum. Your minimum down payment can be 3%. Now, you might have been thinking, wait, I thought I needed 20% to buy a home, right? Using a conventional mortgage. Your parents might have told that, your grandparents, whomever. As a matter of fact, you don't. As a first-time home buyer specifically, you can actually buy a home using a conventional mortgage with as little as 3% down. That's two. Three, LLPAs. Now you're like, what is an LLPA? Well, once again, if you subscribe to my channel, you may have watched a video I did about how lenders' rates can vary from one lender to the next. And part of that video, I talk about LLPAs, which stand for loan level price adjusters. Loan level price adjusters are adjustments that are made on the back side of the interest rate that you'd qualify for that cause it to either be lower or higher, right? It's adjustments for things such as a credit score, a down payment, the type of property you're buying, right? The more risk, the more adjustments against the rate. The less risk, the less adjustments against the rate. Pretty simple. But here's something that's pretty cool about being a first-time home buyer when it comes to these LLPAs. If your income is 100% of the area median income for where you're buying, and you can search that online, or below, there are no LLPAs. Once again, if your income is at or below 100% of the area median income for where you're looking to purchase your property, there are no LLPAs, which means that you're going to get the same interest rate if you have a 620 credit score as someone who has a 780 credit score, which would be considered the top tier, because you don't have those adjustments being made behind the scenes to the interest rate for the risk of having that lower credit score. So that's pretty cool as a first-time home buyer. That's what you're looking at as far as some of the details with this type of loan. Now, why would someone use a conventional loan over an FHA? Well, let's get into that. All right, so first, let's get into FHA one more time, right? So here's the thing. So with an FHA mortgage, we talked about putting 3.5% down, right, versus 3% going conventional, right? So slightly larger down payment. There's more flexibility on DTI, so forth. The debt-to-income ratio, once again. Some other things you may think about, maybe you had a bankruptcy, a foreclosure in the past. If you're not a first-time home buyer, which if you're watching this, you're probably a first-time home buyer, so that would be irrelevant. But a bankruptcy could be something that you might have had where normally you have waiting periods after those credit issues happen. With conventional loans, they're longer than FHA, so that's a factor as well. But let's get right into one of the other huge benefits of going FHA versus conventional. So we talked about the down payment being 3.5%, but what we didn't talk about are closing costs. So when you're buying a property, you have closing costs on top of your down payment. This is money that you're going to pay for services that are rendered for the purchase, right? It could be things like what the lender charges, right? An underwriting fee, a processing fee. Maybe you're going to pay discount points to buy a lower rate. You're going to have a title company involved in your purchase. You're going to pay them for the settlement. You're going to pay them for the title insurance. And you can get more into these things in my other videos where I break all this down and explain what they are, right? That's not what this video is about. It's more about what program is right for you, FHA, conventional as a first-time home buyer. So you have those costs. As I said, you would normally pay for those costs. However, you don't have to be the one paying for those costs. You can actually negotiate into your contract to have the seller of the property you're buying cover the cost for you. So with an FHA mortgage, you can get a seller credit, right, of up to 6%. 6% representing a percentage of the sale price. So for instance, on a $300,000 home, 6% would equal $18,000. That's how much of a credit you can receive from the seller of a property if you're getting an FHA mortgage. Doesn't mean you're going to get this credit, but you can get up to that amount, not exceeding your closing costs because they can't cover your down payment for you. But you can get up to that amount. And what that will do for you, it will potentially allow you to buy a property with just the down payment coming out of your pocket. With conventional, on the other hand, where we talked about a 3% down payment, right, which you're covering, you can also get a seller credit. However, it's up to 3% when you're putting down less than 10%, which you are. You're putting down 3% we talked about, right? So if you're putting down 3%, get a seller credit of 3% on that $300,000 property. 3% credit would be $9,000. Maybe you're saying to yourself, okay, not only am I concerned with my down payment, I'm concerned with my closing costs. And I need to weigh my options. Does it make more sense to go with a conventional mortgage? Does it make more sense to go with an FHA mortgage? Well, the size of the credit that you can negotiate or your realtor can negotiate from the seller of property may be a big factor in that decision that you're trying to make. Because if you just have enough money to cover your down payment and no money to cover your closing costs, well, you may need a larger credit to be able to cover those costs because maybe those costs, depending on where you're buying, exceed 3%. I can tell you they're definitely going to exceed 3% if you're having to buy the interest rate down, and buying the interest rate down means that you're paying extra money up front to get a lower than market interest rate. And you may say to yourself, why would anyone ever do that? And maybe it's not recommended today if it's not a requirement to qualify for the loan, but for some people, they need a lower interest rate to even qualify for the mortgage. And if you need that lower interest rate, it may come at a cost, which are going to be discount points that get paid which would need to be covered if you don't have the money by the credit, meaning that you would need this larger credit. So in a situation such as that one, I would likely lean toward an FHA mortgage, right? Remember that every scenario is different, and you need to understand the pros and cons and why you would take one type of mortgage over the other. It's not just about your down payment. It's not just about the interest rate, right? In this case, it's about the maximum seller credit you're allowed to receive with the type of mortgage you're opting to go for. Now, just another couple of things that you want to think about when you're comparing the two types of loans that I recommend, right? So for one, I'm gonna get rid of this for you. I don't want to confuse you. So FHA, another thing you want to think about, right? Let's just say you have the money for your closing costs, right? That's not an issue. Okay, well, now you're still comparing because you're saying, wait, maybe I can get a lower interest rate on FHA versus a conventional, which by all means, I mean, typically is the case. Government loans, which is what an FHA mortgage is, typically comes with a lower interest rate. However, there are extra costs when you get an FHA mortgage that you don't have with a conventional mortgage. The biggest additional cost that you're going to see is something called UFMIP. And what this stands for is upfront mortgage insurance premium. UFMIP, upfront mortgage insurance premium. You may say to yourself, yeah, I knew I had to pay mortgage insurance. And yes, you're right if you thought you had to pay mortgage insurance. However, that's not what I'm referencing. This is not your monthly mortgage insurance or PMI. What this is 1.75% of whatever you're borrowing, right? So that's not your monthly. This is an additional cost you may not have even realized you're going to have with an FHA mortgage. So let me give you an example of what happens here. So let's just say you have a property. We're going to keep using this $300,000 number. I don't know how realistic or unrealistic that is right now, but it's really just to show you guys the numbers. So you have a $300,000 property. You're going FHA, so you're putting 3.5% down. That means you're borrowing 96.5% of that number. So your loan amount is $289,500. This 1.75 is a percentage of this number. So we take this loan amount, multiply it by 1.75, and the result is $5,066.25, but we're going to use a whole number. This $5,066, you can actually roll it into your loan, meaning that technically your loan amount is more than 96.5% of the purchase price, right? You don't have to come out of pocket. But just keep in mind, just because you're rolling it into the loan doesn't mean you don't owe the money, right? It's still costing you that extra money. So going FHA is going to cost you more money in this alone. On top of that, you have the monthly mortgage insurance, what you were probably thinking of when you heard me say mortgage insurance, right? It's called PMI, private mortgage insurance on conventional loans. It's called monthly mortgage insurance on FHA loans. Now, there's a pro and a con to this on FHA. With FHA loans, the cost of that mortgage insurance, if you're putting 3.5% down, does not vary based on your credit score or anything along those lines. It's the same whether you have a 620 credit score, a 580 credit score, or a 700 credit score, right? You'll pay the same percentage of mortgage insurance. So that's huge, right? It's 0.55% of your base loan amount over a year, right? So in this case, let's just say 289,500 times 0.0055 divided by 12. So this means that your monthly mortgage insurance on an FHA loan would be $132.69 every single month. Negative about that, this never goes away. You're going to pay this forever as long as you have the same mortgage, right? You can always refinance, get a conventional mortgage. Refinancing means you're paying off your existing loan with a new loan. You can go conventional, maybe you have 20% equity at that point in time, allowing you to get rid of the mortgage insurance. However, if you kept this FHA mortgage for 30 years, you're going to pay this mortgage insurance for all 30 years. It never goes away, right? As if you're putting down less than 10%, which is likely what you're doing. We're talking about a 3.5% down payment scenario here, right? So negatives of FHA, an additional upfront cost you want to consider: upfront mortgage insurance premium, mortgage insurance for the life of the loan. Now let's compare that to a conventional loan. So conventional loans, well, there's no upfront mortgage insurance premium. That's pretty good. Right off the bat, you're saving $5,000 in this scenario. However, there is monthly mortgage insurance, as we said, right? And that's called PMI, private mortgage insurance. that you pay when you have a conventional loan, and it's required when you put less than 20% down, which you probably already knew, and if you didn't, now you do. So here's the thing. I mentioned before that the cost of this mortgage insurance is 0.55% regardless of your credit score when you're putting 3.5% down getting an FHA mortgage. However, on a conventional loan, the cost of mortgage insurance can vary substantially based on your credit score. So if you're on the lower tier, right, although you can do a conventional loan with a 620 credit score, right, I told you that was on the low end, right, or versus 780, let's call it 780 plus. That's the high end when it comes to credit scores. Well, your cost of the mortgage insurance on a $300,000 property, if you have a 620 credit score, can easily be $400 a month, where it's going to get cheaper at the 780. It can actually, as a matter of fact, be cheaper than what you would pay here. It could be 80 bucks a month, right? It varies because there's more risk when your credit score is lower than when your credit score is higher. And by risk, I mean your habits of making payments on time or making payments at all, right? That's what lenders are looking at when they're determining risk. That's why the credit score matters so much. So an FHA loan is not as credit score driven, right? The government wants to promote home ownership, so they bring the barrier to entry a little bit lower and make it easier and more affordable. Where in a conventional loan, you're going to see more variances based on things such as the credit score. So that's something you need to consider as well. If you're someone who has a higher credit score and you want a low down payment option, we're likely going to lean toward a conventional mortgage. If you're someone whose credit falls more in the middle or toward the lower end of things, we're likely going to lean toward an FHA mortgage, even though there are some negatives to it when it comes to the overall upfront cost. So these are all things you want to consider when you're making that decision. But no matter your situation, there is a loan program out there for you. Make sure to drop a comment below and let's talk about your exact scenario, and I can help you figure out the best path to take. And make sure to subscribe to my channel for more videos just like this one.